Want to gain 24/7 access to our latest insights and market views? Download our J.P.Morgan Insights app now on your iPhone and iPad by scanning this QR code or clicking the link in the description box below to take our insights with you wherever you go. Now, last week, a new coronavirus variant emerged in Southern Africa with genetic mutations that could make the virus potentially more contagious than prior strains. This led to a sharp pullback in risk assets and fall in bond yields. The new B1.1.529 is named Omicron as a variant of concern by the World Health Organization. Now, these genetic changes could potentially make the vaccines or immunity from previous infections less effective. It is important to recognize that more time, data, and research are needed to understand the full impact from this mutation, including hospitalization and mortality rates. It is possible to alter mRNA vaccines to this new variant, but it would take another 3 to 4 months before the altered vaccines is shipped. A number of governments have already announced travel restrictions with Southern Africa, including the US, the EU, and the UK. Sporadic cases are already appearing in Europe, the UK, and North America. Despite there is still much to understand about the new variant, concerns over the possible impact on the global economic recovery has led to a sharp market correction. Defensives such as consumer staples and utilities, and also sectors that outperformed in the early days of the pandemic, were more resilient in this correction. Safe haven flows have pushed 10-year US Treasury yields back below 1.5% after several months of concerns over accelerating inflation and the Federal Reserve potentially turning more hawkish. Oil price also adjusted significantly. Now, there are some worrying signs on the Omicron variant leading to renewed restrictions and lockdown. Investors should also observe governments' varying approach in dealing with the new infection threat. For example, mobility data has shown that the US and European economies have adopted the live with COVID approach for much of the year, and hence they were able to achieve robust economic growth in 2021. In contrast, Asian governments have been more conservative in limiting cases, even though more of them are now starting to reopen as vaccination rates in Asia rises. Investors for some months have been pricing in a smooth path to recovery, and the Omicron variant poses a new challenge to this constructive view. Therefore, market pressure could remain until medical experts and researchers have a better understanding of the virus. This reinforces the importance of a well-diversified portfolio and the benefits of income generation when asset prices are going through increased volatility. Short-term rotation from equities and other risk assets to safe haven assets such as government bonds could continue. Now, considering government's experience in dealing with the outbreaks and scientists' abilities to alter vaccines and medication in reaction to the new variant, the most likely scenario is a bump on the road of recovery rather than derailing it. This will imply potential opportunities for long-term investors to reload on risk assets, but this would require greater clarification on the impact from the Omicron variant.